Welcome to this video as part of our Emerging Markets series. I'm Lisa Koch, a project finance partner in our Sydney office, and I'm joined by Nick Merritt, a project finance partner in our Singapore office, to chat today about some sustainable finance opportunities and challenges in emerging markets. So Nick, emerging markets are really lagging behind Europe in terms of taking hold of the trend of sustainable finance products. In your experience, what are some of the trends that you're seeing, and why do you think emerging markets are lagging behind to this extent?
Yeah, thanks, Lisa. I mean, the emerging markets are lagging behind, and I'd even suggest that everywhere is lagging behind compared to Europe. If you look at what's been coming out of Europe over the last couple of years around the entire pivot of the union towards a net zero carbon neutral union by 2050, there's a seismic shift happening around the allocation of capital and the regulations coming out on climate change reporting, on taxonomy, on sustainable finance. And there's a real leadership, I think, that's come out of Europe and the UK on that over the last few years. We have, of course, been seeing sustainable finance in Asia. The APLMA, along with the LMA and LSTA, have been supporting the market with the guidance on green loan principles, sustainability linked loans and social loans. And that's also obviously been recently updated in early June to now have verification as a requirement going forward. But I think what's the real change right now is that the governments and the leading markets in Asia, from a government perspective, have really got behind this. We've seen in Hong Kong and in Singapore in particular in the last couple of months, some significant impotence and signaling to the market by the regulators about the importance, not just of sustainable finance, but around things like climate change reporting again, and indeed the whole importance of the taxonomy, the way that we look through and defend and deal with any allegations of greenwash to show that there's real change. The other issue, I think, is that a lot of the corporates in Asia and emerging markets are still largely family owned. So much of the impetus and the drive that's been out there from stakeholders and investors has perhaps been missing in the market. But my sense is that it's being recognized now of being of real value and of interest that is coming now as the market is looking at what has become quite mainstream very quickly across Europe, and the interest in part being driven by the pandemic. And if you look at the volumes of sustainable finance over the last 18 months, 2020 was double what that of 2019, and 2021 remains as equally as strong from a trajectory perspective. And I guess that takes us on in part to the opportunities that people see, not just in OECD countries and other markets. And I'd be interested in your thoughts, Lisa, on what sustainable finance may mean for stakeholders, particularly in the emerging markets that you're looking at.
Yeah, thanks, Nick. For financing in emerging markets, the DFIs have, for a long time been major drivers or supporters of finance in those markets, and that trend is definitely expected to continue with their particular focus on ESG. Interestingly, Sinosure announced yesterday that it's going to be prioritizing financing what they term environmentally friendly Belt and Road projects as part of their larger Belt and Road initiative. So that certainly shows some impetus from a Chinese export credit agency point of view, and a lot of financing in emerging markets actually has Chinese connections. So that's really positive. In terms of other capital providers, we're expecting to see a lot more play from the regional banks in emerging markets generally. And then there's really the question of other funders, alternative capital providers, direct lenders, whatever you want to call them, who get their capital from institutional and other investors. And a lot of the time there are ESG mandates around the investments that they can make, or at the very least ESG parameters or requirements around those investments. At the same time, those particular funders are often looking for higher return opportunities. So there's a sweet spot in emerging markets where there's this tension because there's scope for higher returns, new markets, opportunities. But at the same time, there are a lot of systemic issues. And from an ESG point of view in emerging markets, things like supply chain concerns, a greater reliance on fossil fuels. So there are opportunities, and there's certainly lots of capital to be directed through sustainable finance products to emerging markets. But what we really need is a pipeline of bankable, sustainable infrastructure investment opportunities to really see that come to fruition. On the other side of it, from a government corporate perspective, governments are really recognizing the need and the opportunity to attract green financing. Green bonds have been issued in Indonesia and Egypt, and we really can't ignore how the global trends in sustainable finance and ESG generally are going to impact emerging markets. Certainly the bulk of emissions growth over the next decade or more is expected to be in emerging markets, so there's a need to address that. But also global reporting requirements, as you mentioned, around ESG that will apply to multinationals are obviously going to impact the business that they do in emerging markets. It will impact from a supply chain point of view. We're just talking today about some wind farm developers and turbine operators who are looking for green steel for their turbine production. So you can see it starting to feed through to projects from a supply chain point of view. The court decision in the Netherlands around Shell's emissions is really interesting because that imposed parent liability on Shell for their group emissions globally. So that will again impact supply chain and scope 3 emissions, where emerging markets are really impacted by that. And then finally, as you mentioned, I think the impacts of COVID will really have a positive driving force on sustainable finance opportunities in emerging markets. There's a great need for social and economic recovery, and a lot of that will be driven by investments in healthcare, in education, and so that's in addition to renewable energy and things like that. So there really is a lot of scope in emerging markets for sustainable finance. There's the dual upside of having better or really good financial performance for investments, and at the same time possibilities to have real sustainable impacts on the communities and the environment.
Yeah, and I agree with that. I think the COVID has accelerated the priority of SDGs generally on the government's agendas, and I think even for the people, it's becoming a real focus that, from a combination of recognizing our own fragility and that of the planet from COVID, and also, adverse weather events, and even things like, the extent of waste and plastics that we're seeing in our oceans, particularly here in Southeast Asia. People recognize that there's a need for change, and sustainable finance has a role in driving and promoting that change. This conversation forms part of our wider emerging markets discussion, where colleagues and partners around the firm touch on some of the other issues that are impacting or opportunities that may be available in emerging markets work. Thank you for joining us today, and we look forward to seeing you on our other videos.